Hi, so working in Silicon Valley, it's actually been quite exciting working with life sciences companies because they are certainly very unique companies, just from the standpoint that they have this extended life cycle, in which case it takes a tremendous amount of time and amount of resources in order for the company to move from startup phases through to an actual viable FDA-approved product. And this can include just a tremendous number of clinical trials and R&D to get them to that point. So from that perspective, they are very cost intensive in order to support these R&D activities in those early stages. And because it's such a lengthy clinical trial process, this can last for an extensive amount of time, in which case there's a tremendous amount of financing that is necessary in order to take, basically for a life sciences company to be successful in terms of getting its products through clinical trials successfully and ultimately to receive FDA approval. And so life sciences companies typically have a lot of debt financing rounds, typically a lot of equity financing rounds, in order to continue this cash flow coming in the door so that they can support these R&D activities and hopefully get through their clinical trial successfully and ultimately have an FDA approved product that will in fact be profitable. But this can be a very long, a very intensive process. And because of that, there are certain unique tax considerations that are very germane to a life sciences company. And by life sciences, we typically mean pharmaceutical companies, biotechnology companies, those types of companies. So we've worked with them at Clifton Douglas extensively, as I said, being in Silicon Valley. And with respect to their very specific issues related to tax accounting and just related to basic tax compliance that come about. So with respect to tax accounting, really the primary issues we deal with are share-based compensation. You have all types of share-based compensation, incentive stock options, non-qualified stock options, restricted stock units, and their accounting that relates to share-based compensation can be quite complex. So it's very important if you're dealing with a life sciences company to evaluate on a regular basis that share-based compensation, especially with respect to all these stock options that are being given to employees in order to kind of augment, the lack of cash flow, keep the cash flow, to a minimum, and certainly still incentivize the employees via these stock options. But again, the accounting related to share-based compensation can be quite complex. And so that, with respect to life sciences, is one of the primary areas that needs to be considered from an accounting perspective. Also, because of this long life cycle, in which case it's going to be quite a while typically before the company actually reaches a profitable stage, the company is going to be generating significant amounts of deferred tax assets in terms of these significant net operating losses, and then also tax attributes, or deferred tax assets, tax attributes in terms of R&D related credits, because they're so R&D intensive. So these deferred tax assets really need to be perfected in those early years and carried forward on a regular basis and supported out on a regular basis, so that basically the company can use these deferred tax assets in the later years when the company, of course, becomes profitable, receives FDA approval, has a viable product. But I will say, that certainly most of this deferred tax assets will be offset by valuation allowance, because it's just uncertain as to whether these deferred tax assets and when these deferred tax assets will in fact be utilized. Also, typically there is, with life sciences companies, some form of a reserve that is established against these deferred tax assets. Really an ASC 740-10 or FIN 48 reserve, really the pronouncement is accounting for uncertainty in income taxes, because these life sciences companies, oftentimes due to budgetary constraints, just don't have the necessary resources or funding in order to perform these really in-depth studies and to gather all this extensive supporting documentation to support out the net operating losses and the R&D credits associated with their DTA. So from that standpoint, oftentimes there is a reserve, there is an unrecognized tax benefit that is established for these portion of these deferred tax assets. But certainly when you're dealing with life sciences companies, it's not that big of an issue because you're not monetizing these in any of these deferred tax assets. So the UTB essentially will not result in a FIN 48 liability, and no penalties or interest will apply. The only result from these reserves, from this associated UTB, will typically be a reduction in your deferred tax asset and a corresponding reduction in your valuation allowance. So those are really kind of the key concepts that we run across, very germane to the life sciences company from an accounting perspective. Now, typically from just a standard tax perspective, really kind of comes back down to the tax attributes, because again, in those earlier stages, the company is going to be generating losses, and they're going to be generating R&D credits. They might even, have some various forms of tax planning strategies in terms of basically capitalizing R&D and then amortizing it over an extended period so that they can use those deductions in periods in which case the company is profitable, rather than in earlier periods where the company is, generating losses. But from that perspective, you really need to focus on perfecting those tax attributes. And that comes into play typically with respect to IRC Section 382 and 383 tax attribute limitations, because you've got all of these changes of control that are continually happening with the life sciences company as part of their financing efforts. So in that particular instance, you have changes of control, occurring on a continual basis. And these changes of control may exceed 50%, in which case, these ownership changes may exceed 50%, in which case you have a change of control, and that triggers 382, 383 tax attribute limitations. So you really need to understand, whether or not you have any 382, 383 tax attribute limitations on a going forward basis. Also, with respect to the R&D credit itself, R&D is such a huge part of life science companies from the very beginning, from those developmental clinical trial stages, that it really behooves the company to capture as much of that R&D credit as it possibly can. But it's tricky because the rules and the guidelines surrounding R&D credits are in fact difficult to interpret, and there's a lot of supporting data that's typically necessary to substantiate those credits on audit. The IRS has put together several guidelines very specific to life sciences companies in order to assist them in understanding what related R&D expenses qualify for the R&D credit and which ones are at higher risk for not qualifying for the credit. So again, to the extent that the company can really focus on supporting out their R&D credits as much as possible in those early stages, that becomes very important. So again, from an accounting perspective and a tax perspective, those are really the key considerations. Now, as the company approaches obtains a more viable product, gets through clinical trials, receives FDA approval, and then is of course marketing and selling its product, may become very profitable, in which case it may be looking at going IPO. And in that instance, Clifton Douglas has assisted a tremendous number of companies in Silicon Valley in terms of going IPO, and we actually have we've prepared a video on our specific approach that we like to apply in assisting companies in going public. And so certainly I would encourage you, if that's your particular facts and circumstances, to watch that video. Also, the video refers to one of our Journal of Accountancy articles relating to the approach that we applied and that we found to be successful in taking companies public. And so that's noted in the video as well, which may be very beneficial for you to read that article and look at the approach that we apply. Also, you might have the alternative situation, in which case the company just has not been able to sustain the necessary cash flow that's required in order to get through all of the research and development necessary and the clinical trials necessary to obtain a viable product and to receive FDA approval and ultimately become profitable, in which case it may come to a point where the company is acquired. And similarly, Clifton Douglas has assisted many companies with respect to acquisitions, especially in the Bay Area. And so, from that perspective, we can certainly assist if that's the particular facts and circumstances of your life sciences company. I'd encourage you, we have a video on the particular process that Clifton Douglas applies with respect to acquisitions, and I would encourage you to review that video. Also, in the video, we referred to another Journal of Accountancy article that we've written on our approach in terms of assisting companies in an acquisition from the standpoint of tax considerations and their overall tax function. And so, that's very helpful to review as well, that Journal of Accountancy article. So again, if you are a life sciences company and you're looking for assistance with respect to any stage in the process of your company, whether you're just starting out or you're kind of in the middle, you're kind of more established and going through your end clinical trials, or possibly you're going IPO, or possibly you're looking at acquisitions from a certain perspective, then give us a call. We've dealt with a tremendous number of life sciences companies, and we can be of great assistance. So certainly you can give us a call, as I mentioned, or you can visit us online at cliftondouglas.com. Thank you so much for watching today, and take care. Bye-bye.